Good afternoon, everybody. You're watching SmallCapSteve live, doing a special 2 o'clock show. We got the CEO of GAGE Cannabis join us. Pretty exciting deal. I know that there's been a lot of talk about it, so we figured we'd reach out to Fabian and have him on the show. So buckle up. Let's get started.
Number on you. Yeah, that's how you react when people.
Fabian, is it Fabian or Fabian? Can you hear me?
Fabian.
Okay. So apologies. I may have got it wrong a little bit there in the intro. So today's an exciting day. First day trading.
It's all good. No, it's a pretty exciting day for us. So we're really happy to get out there. Obviously be a publicly traded entity. We've been at it for quite a bit of time as a private cannabis company, and really, really nice to see, to obviously represent the Michigan market as well in the absolute best way possible.
Okay, so let's start with the Michigan market. Why do you find the Michigan market exciting, and why is it the focus?
Yeah, so you know what? It's funny. We don't get a lot of fanfare in the Michigan market just yet from an investor standpoint and just general marketing standpoint. Everyone has such great things to say about the Illinois market, and it's funny. Michigan was right behind Illinois in 2020 in terms of sales, and frankly, is just similarly on pace to have just as big of a year. I think Illinois and Michigan compete for a top 5 spot in the U.S. as a whole. And people kind of forget that Michigan was the second largest medical cardholder, system behind California for the better part of a decade until Florida overtook Michigan over the past year as Michigan went to adult use. So again, a very, very, refined consumer base there. They consume some of the highest amounts of cannabis on a per capita basis. And the numbers that you're seeing are already a 6th largest market in the U.S. So we're here, we're public. We're going to make sure that Michigan gets its time in the sun.
Okay, and we're fighting a little bit of a delay here, but I'm going to do my best. So in terms of speaking about Michigan, everybody knows Florida started out with I think it was 10 licenses, and then they worked their way up to 15, and now there's like 25 or something like that. Apologies, my numbers aren't perfect. Where you got the full vertical license if you were in the state. New York, kind of similar, 5 to 10, where you got the full vertical. But Michigan's kind of it's maybe a little bit closer to maybe like a Colorado or an Oregon, but there's still some hurdles. Would that be accurate? How would you describe the market in terms of acquiring licenses, how defendable they are, and just sort of your limit and the number of stores that you can ultimately operate?
Yeah, no. So Michigan, a little bit of a misconception. Generally people think that it's completely unlimited, license state, which at the state level is true. To be honest with you, you and I can go and get a Michigan license at the state level. We have to actually go and apply it to an actual city. So similar structure to Massachusetts and California, where the cities have a lot of power, and more importantly, the actual locations are a little bit more lucrative than people think. There is an unlimited amount of licenses in each and every respective city. Some cities allow cultivation, some cities only allow retail, and we try to obviously set up our retail in largely in densely populated areas of Michigan. And in some instances, in some cities, there's only 3 licenses that are available, 7 licenses that are available. And yes, there are cities with unlimited licenses, but again, at the city landscape, it's a much, much different story and much, much more competitive, especially for retail locations.
Okay, so my understanding is that in Gage's case, a lot of times you guys get products on the shelves that's selling out pretty quickly. Sometimes you guys are finding inventory drying up in as quickly as 1 week. So you guys are looking to expand your facilities, but you're also working with other providers. How do you go about diligencing, say, a company that you want to work with in terms of their ability to actually bring product to you?
Yeah, no, good question. So, by the end of the 2020 year, we finally got our 3rd cultivation asset up and running. We basically operated the 2020 year predominantly using only 2 small facilities. We're almost our worst enemy. We underestimated how powerful the Gage and the Cookies brand could be. Continually sold out of our product for everything we produced. As we now, move forward to, the end of Q1 here and the beginning of Q2, we're actually seeing, we have 8 different facilities across Michigan where we grow Gage and Cookies product now. And 5 of those 8 are actually contract manufacturing agreements or contract growers. And these are entities that we vetted. These are licensed producers that came to us and said, we want to grow Gage and Cookies exclusively. We really enjoy what you guys are doing with the brand and want to be a partner and essentially want to be someone that is closely tied to this brand moving forward. And we don't just right away obviously enter into these agreements and get someone to grow for us. These are counterparties that we've been working with since the middle of the summer. We've vetted them over and over again. We've purchased wholesale product from them, and we truly saw and ensured that the quality of product that they were bringing to the table for us as a Gage brand, and obviously through Cookies as well, was top-notch quality product. We worked so hard over the past 18 months of our operations to really truly establish a brand in the space, truly establish one of the best brands in Michigan. The last thing we wanted to do was start to dilute our brand quality by not bringing top-notch product to our consumers.
Do you have a sense of where Gage fits right now in terms of like competitors and overall like the largest operator state where Gage would sit?
Yeah, no, I would say there's about a handful of large operators, ones that have accumulated a decently large portfolio of assets. We're obviously one of those 5. I think when you look at how we are going to progress on a month-over-month, and as we start to attain more and more market share, I think we're going to become the clear leader. March was a banner month for us, record month for us in terms of just the amount of product we sold, top line and earnings. So we're looking very, very good as we kind of get into our Q2 run rate here, and also get the real true ramp up of our contract growers. Right now, as I mentioned, we have 5 of them in place, moving to 10 by the end of the year. That's going to help fuel the growth of Gage. It's going to help fuel new flavors. It's going to help fuel new products that we're able to bring forth at a quicker pace. I think, the key thing about Gage and what's made it so successful versus some of the other competitors in Michigan, because again, it's a competitive market. If you come to Michigan, you're dealing with legacy operators that have been in the business for 10 plus years. They know how to grow cannabis, and they grow some of the best cannabis in the world, if not the US. And so when you're competing with those, you need to be on top of your game. And for us, we really have a broad flavor offering when it comes to our flower. We focus hard on the post-production process. And so as we progress, as we come out with more and more flavors, more and more variety, it keeps the consumer coming to our stores. And I think you'll see our market share slowly but surely on a monthly basis get to really, really, market leading levels.
Okay, so let's talk a little bit about Bruce Litton's involvement. And one of the questions that came to us when we were doing our research here is Bruce, he often mentioned how important it is to provide equity incentives beyond the C-suite. And then looking through your listing statement, it appears as though you guys gave about 25% of your equity pool to non-executive employees. How important is it in your mind to allocate equity to non-executives when embarking on an aggressive growth path such as Gage is doing right now?
Yeah, no, I think, look, whenever you're growing a business, a small business, and, obviously to start, which was us, 18 months ago, really need to distribute, the amount of equity that you have in order to incentivize people to work with your company and potentially, save on cash as well. There's a lot of opportunities where people say, I really believe in what you're doing. I really want to be a part of it. And those opportunities we had to, not necessarily use the cash that we had on our balance sheet, but also, give potentially individuals that, work with us on, a consistent basis on the construction side of things, to actually have some skin in the game with us as well, take some equity or, options in the company versus, straight cash payments. When it comes to our executives as well, I think if you can see, go through our prospectus, not, the founders, myself as an executive as well, and founder of the company since inception, we didn't really pay ourselves up until the 2020 year. And go through each and every one of those years and actually see that the majority of the, the payments that we received, let's quote unquote payments, were via equity. And so we tried to, ensure that we stretch shareholder capital as much as we could while we were a private company. And frankly, if you take a look at some of these other MSOs, the amount of money they've been able to raise, hundreds and hundreds of millions of dollars, up until our Reg A financing, we had only raised 60 million. Sounds like a massive amount, but when you take into consideration what we've been able to do with such little amount of capital, I think is again a testament to the way we incentivized not only our employees, but also some of our non-employees and individuals that were cheering us on the sidelines.
Okay, so let's talk a little bit about that capital. So you guys are committed to a very aggressive expansion plan. You got $30 million on the balance sheet, and from our research, you're targeting about
45, closer to 45.
Okay, closer to 45, so a pretty big number. And from our research, you're targeting about 13 cultivation facilities by the end of the year. What? One of the most important things for any cannabis producer is making sure you are maximizing efficiencies at the production level to capture downstream margins. Are there any particular technological, human, or other methods that GAGE is looking at when building out these new facilities and trying to maintain those margins downstream?
Yeah, so let me clarify just a couple things quickly. So yeah, obviously, just on the cash, obviously closer to $45 million with the diluted securities we have would bring another 80 million in cash as well. So that's a key point, to keep in mind. We're fully funded to execute on our 2021 plans in Michigan. When it comes to the cultivation assets, remember, we have 3 of our own cultivation assets that we operate. The third cultivation asset that came online in December, that is currently engaging in a phase 2 expansion. And so we'll have that phase 2 expansion completed by the end of the year. The cost to complete that facility, that 80,000 square foot expansion, is approximately 15 million US. And so more than enough capital on the book to execute on those. The contract growers, the key part of that strategy, remember, it's zero CapEx to us. We did not build those facilities. We are not going to build those facilities that are coming online. It is the actual licensed producer that's doing it. When they are online, zero OpEx to us as well. I don't pay for them to actually produce the product. They actually cover our testing, packaging, and secure transporting as well. So I'll give you a quick example. $6,500 a pound is roughly what we sell for in Michigan. If you go on our website right now, go to any of our locations, you look at the GAGE branded, bags, the monikers and logos on them, or the Cookies branded GAGE bags, you can actually see that those are the ones that we produce at GAGE and through our contract growers. Each and every bag of 8s sells for 55. And so when you actually look at it on a per pound basis, that's in excess of 7,000. But just for example purposes, you will use 6,500. So with my contract grower, I'm sharing in 50% of that 6,500 with them and withholding $250 for the packaging, testing, and secure transporting. So for $0, I'm getting product on my shelf from these contract growers. I'm expanding my flavor offering, and I'm achieving 50+% gross margins on it. There really isn't any other company out there that's been afforded this type of opportunity because of how strongly of a brand that we had built in Michigan. We now have these opportunities where licensed producers want to grow for us. So those 10 facilities that will come online that are contract growers, we're paying nothing for those to come online.
There's no CapEx component or cash down component? Zero,
absolutely zero. No cash component, no CapEx requirements. These are all licensed facilities that are owned by those license holders.
So if I'm a cultivator, why do I agree to do that? Well, walk me through my mindset if I'm a cultivator who agrees to do that deal with GAGE.
Yeah, no, for sure. So I think the key point is there's a couple financial benefits and obviously a couple of intangibles as well. On the financial side of things, keep in mind, great quality product in the state of Michigan. You're looking at, a couple months ago, $2,400 to $2,600 a pound. I'd say that pricing has now moved up to about $2,600 to $2,900 a pound for, again, good, high quality indoor product. When you take a look at what contract grower is getting by working with us, remember, we're selling for some of the highest price points on a per pound basis in the state of Michigan. So that contract grower is receiving in excess of, $3,000 a pound, much higher than what they're getting for top tier product in the market right now. And so financially, it makes sense for them. And obviously financially, it makes sense for us. More importantly, think about now what that cultivator needs to do. They're focused on specific amount of strains. They don't need to pheno hunt. They don't need to come out with new products. They're just solely focused on those flavors of product within their location. So they have consistency in what they're growing, can start to maximize those yields with that consistency. Now take into consideration who's buying the product. One, purchaser. They don't need to go in the market. They don't need to find somebody. They don't need to worry about not getting paid after they delivered the product. They come to us. We pay them. It's one purchaser. There's consistency in that. And so I think when you couple that with the financial benefits, they're already ahead of the game there, it creates a pretty strong incentive. We're actually right now accepting any further contract growers, and we have a long list of contract growers that want to do business with us. In fact, even for potentially better margins as we move forward.
Has this model been successfully delivered in any other state, or would this just specifically work in Michigan because of the nuances of the regulatory environment?
Yeah, no, that's a good question. So I would say it makes it much easier to have this model in place in a place like Michigan. Michigan is, I think, a very, very well-developed market when it comes to product quality. Again, the caregiver model in Michigan has been around since 2008. So you have just a huge, massive amount of great cultivators in one place. So I think in Michigan, you have that opportunity. Will you have that opportunity potentially in other states? It's tough to tell. Again, I need to see, what kind of quality you're looking for. What kind of quality we're looking for in a partner. But I think if you now look to our brand partner, Cookies, kind of employed this model. A lot of the product, that they have to market is employed via contract model. So you take a look at their partners in California, they operate in a similar fashion. So you kind of seeing Cookies being the leader in, this type of strategy and performing exceptionally well as a brand because of it. You have this massive network of people that just want to grow Cookies product in California. And then not to mention, you're just getting tons of, the best in class breeders, the best IP that you could possibly think of coming to Cookies and saying, please let me work with you. So I think in a place like California, it's worked exceptionally well for a brand like Cookies. For us in Michigan, it's working exceptionally well. Again, both markets where there's extremely good quality flower, variety of flavors as well. We'll see if this model can be employed in other states, and Gage will be expanding to other states in the future. And this is a model we hope to, kind of go through and implement across the country.
Okay, so something I like to ask management teams, it's my first time having you on here. If you're a shareholder in Gage, and let's say that this is December 31st, 2021, you come back on and we evaluate your performance for the year. What are the metrics or the hurdles or the checklist that we should measure you on to evaluate your success as CEO of Gage?
No, that's great. No, good question. So I think first on, cultivation ramp. I told you before, I'll be the first to talk about things we didn't do well. In 2020, didn't get enough cultivation ramped up to actually fully take advantage of the demand that we were seeing for our product. So for me, in order to evaluate how our performance and including my performance, for sure, we want to see all 13 facilities. And more importantly, we also want to see the expansion at Monitor Township, which is our third facility, actually get completed. It's an 80,000 square foot room only expansion. We are going to be hopefully enclosing that particular facility this month. So we've obviously put the building up, just doing the concrete floor right now, have the preliminary preliminary work done. And so we'll enclose that building. Going to be working on it for the next 4 to 6 months from an interior standpoint. So most definitely you want to see that as an investor, get that, closer and closer to completion. You want to see us continue to add, our contract growers and have them come up to operation. From 5 now in operation, you want to see all 10, come into operation. Take a look at our processing as well. We haven't ramped up any of our processing at all in Michigan. We have 3 processing assets. 2 of them are more packaging and distribution hubs. At Monitor Township, we're going to be building our own processing lab, really trying to go after the extract-based market. We haven't really done that yet. We don't really have a huge variety of carts, don't have a huge variety of concentrates in Michigan right now. A couple flavors that you'll see on the cart side, a couple flavors on the concentrates. We really want to start to expand that. We need to have our own processing lab to do that. Make our own distillates, ensure we can fill our own pens, make sure the terpene profile is top notch so that we bring, a big, huge, let's call it cart line or pen line to the market. It's top notch. And so for us, that's another key thing to look out for. We should have that completed by the end of Q2 of this year. And then lastly, I'd say our retail opening. We focus 100% on pushing everything through our retail channels. We have the opportunity to control the narrative on the brand. We have the opportunity to actually, truly focus on how our brand is received by the consumer. We want to keep up with that. We don't really want to do a lot of wholesale. Right now, I have 7 operational stores. I'm trying to get to at least 20 locations in my hand by the end of this quarter and have those same 20 locations open by the end of the year. So basically, I have 7 operational. I need 13 more. Going to really keenly focus on that. We have a couple acquisitions in the pipeline. So I think, like any company, those are the things I would focus on for us to gauge our success, no pun intended. And I think, if we can execute on those 3, we do have the brand, we do have the price point to really create some outsized gains for, investors and shareholders at this time that are coming into the name, today as an example.
All right, well, Fabian, thanks so much for taking the time to do this. This is exciting. I know it's for you. This is probably an extremely exciting day. I'm guessing you didn't get a whole lot of sleep last night.
No, it's been a rough couple of days, I'll tell you. Yeah.
But I really appreciate you hopping on here, and we're going to be following the story as you guys move forward. And I think the Michigan market is really interesting, and a lot of people are sleeping on it. So this is an exciting deal to watch.
Yeah, no, thanks a lot for your time, and obviously thanks a lot for having me on. I appreciate it.
Perfect. Okay, so guys, that wraps it up for this little 2 o'clock edition. I just would like to give a little disclaimer here that nothing that we talk about is buy or sell recommendation. Nothing is meant to be financial advice. This is for informational and entertainment purposes only. If you're looking for that sort of thing, go find somebody who's licensed, of which I am not. We'll be back tomorrow at noon with actually, I don't even know who our guest tomorrow at noon is. I think it's Mark Chandler. So that should be exciting, or he's Thursday. I guess I'll find out afterwards. Anyways, we will see you guys tomorrow at noon. Thank you so much for joining us.